In this video, I'll cover everything you need to know about residential home mortgages. And we're starting right now. Hey guys, Elliot here. So as I'm sure you've noticed, homes and home mortgages have been in the news a lot in the last few years, and often for all the wrong reasons. Home inventories are at an all-time low with prices and interest rates sky high. As a result, it's been a tough market to enter into, and the numbers bear this out. In 2023, there were approximately 4.3 million new mortgages originated. Overall, that is a 30-year low, but the raw numbers don't reveal the entire story. If you look closer, first-time homebuyers made up 55% of these new mortgages, which is actually a 10-year high. This shows that despite the tough real estate market, the dream of owning a home is still very much alive and well. But it's more important than ever, especially if you're a first-time home buyer, to get into this knowing everything you can about mortgages and to make sure you get the right one and with the best possible terms. A house is, after all, the biggest single financial purchase most people will make. With that in mind, let's jump into this short but comprehensive overview of home mortgage fundamentals. We're going to cover all the different types of mortgages, what goes into them, what to do before you apply, and include an example of a mortgage calculator and an amortization table. And since I'm a licensed mortgage originator, I'll let you in on some industry secrets along the way that will save you money, so be sure to stick around until the end. So the place to start learning about mortgages is with the one that the majority of home buyers have gotten for generations, and that is the 30-year fixed mortgage. The concept is very simple. You put down a down payment, take out a loan for the remaining amount, and pay off the principal and interest equal monthly payments for 360 months or 30 years, and at that point the home is yours free and clear. Since the 30-year fixed is the most popular mortgage option out there, let's use it as an example and break it down further so you know exactly what you're getting into. Every mortgage payment is made up of 4 critical items that you must know about, and they go by a very cute acronym called PITI. PITI, or P-I-T-I, stands for principal, interest, taxes, and insurance. Let's describe all 4 in a bit more detail. Principal is the actual cost of the home minus the down payment you put down initially. Just about everyone in the mortgage industry will encourage your prospective home buyer to put down at least 20%, and just about everyone knows this will rarely happen. With the median home price exceeding $500,000 in some markets in the US, many buyers will end up putting down 10 or even just 5% as a down payment. Whatever the amount left over will be the principal. Next is interest. This, of course, is the cost of borrowing money from the lender, and the rate will make a huge difference in how much you pay monthly and overall during the life of the loan. Home mortgage interest rates are not directly set by anyone particular, but they are heavily influenced by the prime rate that banks use as a baseline for consumer loans, and those in turn are very much influenced by the fund rate of the Federal Reserve, so you can pretty much say the Fed influences how much you pay for the mortgage. At the time of the filming of this video, the average home mortgage rate is hovering around 7.5%. Next is taxes. This refers to the property taxes that are assessed and collected from every homeowner. These taxes are levied by local governments and are used to pay for infrastructure such as roads and sewers, as well as services such as police, fire, and schools. Everyone pays property taxes, including businesses, and if you're an apartment dweller, it's just rolled into your rent. The actual amount paid, at least for residential homes, is tied to the assessed value of the property, with the national average just over 1%. Finally, we have insurance, and that typically refers to the homeowner's insurance that you are required to carry when you take out a mortgage. It may also include what is called PMI, or private mortgage insurance, which you're typically required to have when you put down less than 20%. Now, although you pay for it, PMI actually protects the lender. It compensates them for the extra risk they're assuming by extending a larger loan and demanding less cash upfront from you. Not all mortgages have PMI, some are accepted, but if you do have to pay it, it doesn't last forever and is typically canceled after your equity in the home exceeds 20% of its value. So there you have it. Now you know the details of the principal, interest, taxes, and insurance, or PITI, and together they make up a typical monthly mortgage payment. You may also have what is called an HOA, or Homeowners Association fee. This is charged monthly by the local community you live in and pays for things like a pool, clubhouse, playground, landscaping, or security. HOA fees vary widely, but can be as high as several $100s per month. About 65% of all homes in the US are part of an HOA, so it's far from everyone, but we can include it in the overall home ownership expenses for the sake of completeness. So next, you need to know how this all works to together and how much your monthly mortgage payments will be, as well as how much you're actually paying for all the components of PITI. For that, you can use a simple mortgage calculator, which are freely available online for everyone to use. Here's one that I like from Forbes Advisor. In this example, I assume the home price to be $425,000, which is close to the average for all homes in the US. The down payment is 6%, which is the average amount put down by a first-time home buyer, and it works out to $25,500. The interest rate I assume to be 7.25%, which is close to the current national average, and this will be a 30-year fixed-rate mortgage, which is what we've been discussing so far. Finally, to get a really accurate monthly payment, you need to enter realistic values for the homeowner's insurance, property tax, PMI, and HOA fees. For the property taxes, I just took the national average of 1% of the home's value, which is $4,250 in our case, and divided it by 12, getting $354 monthly. For the other three, I simply took the national averages given the price of the home and the down payment. These values may not be exactly what you may have in your specific case, but they're close enough for example. And here are the results. Your monthly payment works out to $3,729 per month, with the principal and interest taking up nearly 3/4 of that. These calculators are great for playing around with the numbers and seeing exactly how slight changes in all the different factors will influence the final monthly payment. I strongly encourage you to try this out yourself, and I left a link to this Forbes Advisor mortgage calculator in the description below. Now, what I need to show you next is called the Amortization Schedule, and it's nothing more than a chart which shows you how the principal and interest are being paid off over time. While it's a fairly simple calculation, it's a very revealing one because what many people don't realize is that a typical residential home mortgage, such as the 30-year fixed, is very much front-loaded. This means that you will pay a lot more in interest than you will in principal as you start the payments, but as time goes on, the payments will equalize until eventually you are paying more in principal than in interest. Take a look, here's what I mean. On this chart, the green is the principal payments, the yellow are the interest payments, and the black line sloping toward the right is the overall balance remaining. In the first few years, only a small percentage of your monthly payment will go toward paying off the actual home, with about 80% of the money going straight into the pocket of the lender in the form of interest payments. It's only about halfway through your 30-year mortgage obligation that your interest and principal payments start to equal out, and only in the last few years that you're really paying off that principal in earnest. Now, why is it set up this way? The simple answer is that this is how the banks make their money from home ownership, and yeah, it can be quite a shock to realize how much of your money is initially going to support the interest payments. It can also be a shock to learn how much the mortgage will cost you in the end. Borrowing $425,000 for 30 years at 7.25% interest will set you back about $618,000 in interest payments for a total of well over $1 million for what was originally a $425,000 home. There are of course ways to save on this, including getting a shorter term mortgage such as 20 or 15 years instead of 30, or at the very least make extra payments whenever you can throughout the life of the loan. You can also refinance the mortgage whenever interest rates drop, and this alone can save you hundreds of dollars per month. So thus far we've discussed just the 30-year fixed mortgage because it is, as I mentioned before, the most common one out there. It's referred to by mortgage professionals as a traditional or conventional loan. These types of loans exist entirely in the private marketplace and are not backed by any government agencies. The vast majority of these can also be referred to as conforming loans, which just means they conform to standards set forth by agencies such as Fannie Mae and Freddie Mac, who then repurchase these loans and resell them as securities. They do this because it frees up capital for the banks, who in turn can make more loans. The qualifications for conventional conforming loans are fairly high, and the guidelines are a bit more on the conservative side. To qualify, you will generally need a very good credit score, have a sizable down payment, and cannot have too much debt. I'll cover all this in more detail in just a few minutes when we get to the personal finance side of getting a mortgage. But in the meantime, what other kinds of mortgages are out there? Turns out many other types, and a few are very much worth going over. The one that needs to definitely be mentioned next is called the FHA loan. FHA stands for the Federal Housing Administration, and while they do not directly make loans, they do insure loans that are made by approved lenders. Because these mortgages are insured from default, their standards are not quite as high, and they often don't require a high down payment either. FHA loans are ideal for those whose credit scores are not quite in a very good category, or they can only come up with a small amount of down payment. Another type of loan you need to know about is from the VA, which is of course the Veterans Administration. VA loans are only for retired and active duty military service members and their spouses, and feature some very generous perks such as zero down payment and no PMI, among other benefits. Another excellent program is from the USDA, or the US Department of Agriculture. Now, while you typically associate that agency with food inspection, they also back a large number of mortgage loans made to low and middle income Americans who live in the rural parts of the country. If you fall into these two categories, either a veteran or live in rural farmland, you absolutely need to check out these sources of mortgages. Finally, I need to tell you about adjustable rate mortgages, or ARMs. These are generally considered subprime, and they're surrounded by a bit of controversy and definitely not for everyone. ARMs come in many flavors, but the essential concept is that they start out with one rate for a number of years, which is referred to as a fixed period, and then switch to another rate during what's called the adjusted period. A typical ARM is then called a hybrid and features both of these periods. As an example, a 5-1 ARM will remain fixed for 5 years as indicated by the first number and then adjust every year thereafter as indicated by the second number. ARMs are appropriate in certain situations, such as a short-term purchase to flip a house where the lower initial rate is all you care about. However, ARMs can be a really bad idea for long-term homeowners as they are unpredictable and the interest rate can suddenly go up, leaving the borrower with payment shock. Okay, so you've got a lot of info on mortgages themselves. Let's now discuss the personal finance side of qualifying for a mortgage and finish off with the actual process of getting one and what you can expect when you get in touch with a mortgage loan originator and apply for a loan. Before you do apply, it goes without saying that you need to get your finances in order. You have to first realize that a mortgage loan is not approved or rejected based on your personality, how well you get along with the loan officer, or by how much you think you need the loan. Cold, hard numbers are what loan decisions are based on, and none of them are a secret. They only seem that way to an unprepared borrower. The truth is that you can evaluate your own finances, fix what needs fixing, and apply knowing exactly what the results will be with no surprises. The lender wants to know just two things. What is your ability to repay the loan and what is your inclination to do so? To determine ability, they will check your assets, liabilities, and earnings, and they will show exactly what is coming in and coming out and if a mortgage payments fit into that picture. To determine your inclination to pay, they will check your credit and credit score, and those will show how well you repaid your debts in the past and if you're likely to continue doing so going forward. So let's briefly take a closer look at both of these one at a time. The first thing you will need to do is evaluate your assets, liabilities, and income. The ideal situation is that you have a steady job that you've had for some time and you have little debt and significant savings and investments. You'll be asked to reveal all of the above, so sit down and go through these on your own before you even think of applying for a mortgage. If you have debt such as car loan, student loan, or a credit card, the total amount may be too much to also take on a mortgage payment, so see if you can repay some of the debts first. Check your assets. Do you have some emergency savings, a 401k, or perhaps other investments? All of these will come in handy to show you have liquid collateral and are responsible with your finances, and unless you're applying for a VA loan, you will need a sizable amount for down payment and closing costs. Finally, check your income. If your job is unsteady, seasonal, part-time, or you're self-employed, you may have problems when applying and you should try to stabilize your employment situation first. It would be good to also do your own DTI or debt-to-income calculation. It's easy and very informative. You simply add up all your monthly debt payments and divide the total by your monthly gross income. You will get a decimal value, so just multiply by 100 to get a percentage. For example, if your monthly gross income is $5,000 and you want a house where the monthly mortgage will be $1,500 per month, but you also have a car payment for $500 per month and a student loan for $400 per month, your DTI will work out to 48%, which is higher than allowed by most lenders as they would prefer 45% or lower. You would need to pay off either your car or student loan, look for a less expensive house, or get a better paying job to lower that ratio. Last but not least, check your credit. It should be very good or excellent, which is generally a score of 720 and above. If it's not where you want it to be, take some time to sort things out and perhaps pay off a credit card or a loan. That will not only boost your score, but also improve the DTI. Remember that while yes, there are ways to overcome financial and credit issues, and there are mortgages and programs tailored to less than ideal situations, you really want to walk in with your best foot forward, as in the end it'll come down to perceived risk. The riskier you seem as a borrower to a lender, the more interest you will be charged, so if you have all your ducks in a row, it's you who will save and benefit the most. Okay, when you're ready to go, visit your local mortgage loan originator office. You should first take some time to read reviews and pick an experienced MLO with solid reputation, including in customer service. These professionals will be critical to recommending the right mortgage to you and guiding you through the entire process. That process begins with you getting a pre-approval for a loan by filling out the Uniform Residential Loan Application, also known as Form 1003. You will be asked to reveal all the financial details I discussed in this video, and once the agent receives and analyzes this form and runs your credit, you will get an answer. If you are pre-approved, you can start looking for a property with the buyer's agent. Having that pre-approval in hand will actually make you a stronger candidate in the eyes of sellers and real estate agents alike, with some even refusing to work with buyers that are not vetted in such a detailed way. way. If you find a property you want to buy, you can then complete the final application process and go through underwriting, where not only you but also the property you're interested in will go through a detailed analysis, including a title search and an appraisal. If everything stays on track, you will lock in your rate and close on the property. This is of course a simplified timeline, and there will be numerous other steps, big and small, but your MLO and your real estate agent should help guide you. Okay, I hope you enjoyed this overview of mortgages and learned a lot. If you did, please do like and subscribe, and I will see you all in the next video.